Hey, well, thank you very much, Kevin. Thanks for having me here today at the Reals Traders Expo. Excuse me. So, got a nice full house, and we're going to be talking more about options, one of my favorite things. So, again, appreciate everybody being here today. So, let's get started here. Now, what I'm going to talk about is a five-step plan I put together for option income success. And step one is you need to avoid the number one option trading mistake. So, we'll go through that. Two, most important option factor. Three, how option pricing works. You need to understand the pricing mechanism to know what strategies to look at and how to use them. Four, knowing and using the market maker's secret. Five, highest probability option strategies for every market. So the following webinar is purely for educational purposes. Any stocks, options, futures mentioned does not constitute advice and should not be construed as a recommendation. So appreciate the intro. Yeah, I've been actively trading for over 30 years and was previously executive vice president for Trans World Oil, which is one of the largest oil trading companies in the world. And it was a really great learning experience for me. I ran their international trading desk for over 10 years. But as doing that, you're constantly learning, and you learn a lot from your mistakes. So a lot of stuff that I'm going to teach you here today is, stuff that I've learned, and some of it from trading mistakes. So we went on, we traded Forex and all the derivative markets, but we were one of the first groups to start trading options on over-the-counter crude, and that's what really got my interest, and that was back in about the mid-'80s, and then went on to launch the institutional over-the-counter option brokerage desk for PVL Oil London, the largest privately owned brokerage company, oil brokerage company in the world. So another great learning experience there. So basically trading is a journey of education and learning. And trading can be one of the most rewarding jobs on the planet, but you really have to stay educated about what you're trading, and you really need to focus on managing your risk. So it's risk management's the key to success. And the other side of the coin is it can also be very, very painful at times, which probably everybody here can attest to. Now, when I went out and started trading my own account, I had to really change the way I was looking at things, because it was a totally different style of trading from, managing other people's money to do it in your own. And, when it's your own money, those losses become so much more personal, so I had to quickly better control my risk. And my real kind of I call it aha trading moment, came when I started to incorporate these income type of selling option strategies into what I was currently doing. So I've always been into the options, but this is really something that helped me to become a more consistent trader, and that's what we're going to talk about here today. So step one is avoiding the number one option trading mistake. And what is that? Well, option trading has so many more advantages than trading stocks, but as you probably know, it's a bit more complicated as well. And for the individual trader, options can be a little intimidating at times. So that's why many investors trade options by purchasing out-of-the-money options, often those short-term options, since they cost a lot less than a long-term option, and it's basically a simple strategy. So for example, out-of-the-money calls, or out-of-the-money options in general, are very popular because they're cheap. They seem to follow the old Warren Buffett paradigm that we've all kind of grown up with in trading or investing, and that's let's buy low, sell high. But is this always the best strategy? So imagine you're bullish on Facebook and it's trading at 100. Now, as a beginning option trader, you might be tempted to buy calls 30 days from expiration with a strike of 120 at the cost of 15 cents, which would be $15 per option contract. And why would you do this? Well, when you look at it, you can do a lot of them. So let's look at the math. Now, if you were to purchase 100 shares of Facebook at $100, that would cost you $10,000. But for the same $10,000, you could go out and buy 666 contracts of the 120 calls, controlling over 66,000 shares. Wow. Then you look at the math, you do a little bit further calculations, and you say, well, what if Facebook was to hit 121 within the next 30 days? And those 120 calls that you had bought are trading now at $1.05, which is 105 per option contract just prior to expiration. Well, you do the math on that, and you'd see you'd make over $59,000 in 1 month. So at first glance, this kind of leverage is awesome. It is. But you don't want to let this glitter fool you, because not losing money is just as important as making money. Now, the one problem that you have with short-term out-of-the-money calls or options in general is that you not only have to be right about direction the stock moves, but you also have to be right about the timing. And that really ratchets up the degree of difficulty. So to make the profit, the stock doesn't just need to go past your strike price, but it also has to do it within a defined period of time. In the case of the 120 calls on Facebook, you need that stock to reach 120 within 30 days to make your profit. Now, it's this dual objective of having to be right on direction plus timing really lessens the probability of an option trade being a winning trade when you're just always buying options. And everything I teach my clients is that based on managing your risk and increasing your probabilities of winning trade, it's what you really want to go for. So in this Facebook option trade, you're wanting the stock to move more than 20% in less than a month. And this would be like a 2 standard deviation move. And how many stocks are likely to do that? Well, we'll see the occasional, the Netflix or the Teslas or Amazon or whatever that'll have these big, powerful moves, but in all reality, not many. And in all probability, the stock would not reach its strike price and the options would expire completely worthless. So based on probability, using standard deviation, there's only about a 5% chance for this stock to reach 120 or 121 by its expiration. So in order to make money on those out-of-the-money calls, you either need to outwit the market or get plain lucky. Now, we used to always kid around the trading room, and there was a blues song, and one of the lines in the blues song was that if I had no bad luck, I'd have no luck at all. So how many can raise your hand to that particular situation when things go against you? It's usually the bad luck that kicks in. So being close means no cigar. Now imagine Facebook rose to 110 during that 30 days of your option lifetime. Well, you could be right and say you're right about direction the stock moved, but since you're wrong about how far it would go within the specific time frame, you'd still lose your entire investment, and that's always outright painful. So based on this trade example, a better goal for every trader would be to select trades based on what provides you the most consistent positive returns and not a one-time big winner. So you don't want to try to hit home runs every time. You want to be consistent. And consistency is derived from making high probability trades based on reliable data and facts. Now, where there's a big disadvantage, such as the one you just saw in the option buying scenario with Facebook, you can usually just flip the other side of the coin and see an equal and opposite advantage. So in this case, being a seller of those options gives you a huge advantage over being a buyer. Now, all the pros know this, and they're going to take advantage of it. So they're going to tend to trade from the sell side. So as a seller, all the things in that example that you just saw are the same, but they are in your favor instead of against you. Now, step 2 is the most important option factor for income generation, and it's understanding the concept of time. And that's pretty simple, from that example you just saw. Now, time value is used for trading strategies. It's very, very specific to really helping you in trading strategies that take advantage of the accelerated time decay of the option into its expiration. And these option type income selling strategies are very tied to the time value and the impact that it has on the price of your option. So what is time value? Well, time value is what we call the extrinsic part of the option. It's the premium a rational investor would pay over its current exercise value, which is known as the intrinsic value, based on its potential to increase in value before expiring. Now, this probability is always greater than 0, thus an option is always going to be worth more than its current exercise value. So I'm going to show you a chart, and after you see this chart, it'll show you how predictable and powerful that this option paradigm can become, and then I want you to answer a question here. So one second, let me get my drawing pen here. One moment. So, when you start, here's the time graph starting 120 days out. Now, when you're way out here on this curve here, where it's 120 days out, your time decay is very, very small. And we can measure this, and it's what we call theta. So when you're first starting out way out of the money, I mean way out in time, say 120 days out, you'll notice on your option platform that you'll probably see a minus 0.01 or something, minus 0.001. So basically that would be $1 per option contract that is the time decay on your premium each day. Now as you go in further or closer to your expiration, say 30 days out, weekly options, etc., you're going to get a really acceleration of time decay. Before you know it, you're at zero. So I call it time decay on steroids, or turbo time decay. So just think about it. If this is like a current, swift current going out, that's your time decay. If you're constantly trying to buy options against that current or swimming against that current, most of the time you're going to have a hard time making any money. So you have to have a very powerful trend in the direction of your trades in order to combat that negative effect that time decay gives to your option premium. So think about it. So if the underlying security that you were to buy was to go sideways, having no directional trend at all, would you have wanted to have bought those options 120 to 90 days out, or would you have rather sold? So if you'd rather sell options 120 to 90 days out in that situation, just type in a Y for yes, or no for no. Yes, yes, yes. So yeah, that shows you, illustrates the time decay that you have, when you start out and then as you get closer in. So if the trend is not going in your direction that you say you bought long calls or puts for, and it just sits there stagnant, you're going to lose your entire premium based on time decay. And this is the natural time value progression for all options. And it's seriously like falling off a cliff blindfolded. If you're walking around in a blindfold in a mountain range, you're going to probably fall off and break your neck. Now step 3 is then how does option pricing works? And it's a simple concept. So if you just understand the mechanisms that control price on an option, then you can kind of understand what option strategies to look at and how to use them. So basically the value of an option is just, the main components is time value times the implied volatility times that intrinsic extrinsic value. And once you know these variables, then you're going to be ready to price the option and know what option premium it should be. So here's another little table to illustrate time value a little bit further. Now every Thursday you have a new series. This is a weekly options series. So every Thursday you have a new option series that comes out. And when that comes out, it's got 100% time the first day. So time value times implied volatility times that intrinsic extrinsic gives you your premium, or the cost of the option. So in this example, we'll leave this constant, and you can see how it flows through. So day 1, 100% time times implied volatility times intrinsic extrinsic, $300 value of the option. Now, you look down here, when you get to Monday, you see it 0.50. So you're basically cutting that option value in half based on the time value component of it. Even if you raise the implied volatility in this situation to 800, you barely get a push to the premium at all. It only goes up to 400, and then before you know it, you can see you're down to 0. So you can see how that time decay really starts taking charge. Now step 4 is the market maker's secret, and this is what they don't want you to know, because they tend to sell, play or trade from the sell side, and this is why. If you look at broad markets, you'll notice that they'll have, trends that can last 2 to 3 weeks. And then all of a sudden you'll see the markets trade sideways, kind of in channels for a long period of time. And 70 or 80% of the time, they'll just kind of channel sideways, trying to regain their energy. So it's based on the sideways price action or movement that out of the money option buyers are going to lose approximately 70% of the time. Now the market makers, they know these statistics, and therefore they're going to tend to trade from the sell side, because it's going to be statistically a higher probability that they're going to be winning from the sell side. And this is the professional money, so you really want to think and understand what these guys are doing, and then you want to do the same thing. And it's all based on the math of probabilities. So the market makers, they use mathematical market probability statistics for pricing out the options, and they're using a model. And you can do the same now. Now, knowing the probability of the underlying security you're trading finishing within a certain range at expiration is really key when determining what options you want to buy or sell and what option strategy to implement. So it's these statistics forecast how likely it is that an option will fall within a certain price range up or down by its expiration. And it's this statistical forecast is what we refer to as the implied move of the stock. Now, it's this implied move that is a theoretical estimate of a plus or minus 1 standard deviation move of the underlying security. So that sounds all complicated and everything else, but when you look at a couple of examples, it's very clear. So here's what we call the normal distribution curve for statistics. And so what you're going to see after I go through this example is how it works. Now, it's based on these probability statistics that selling options and option spreads, when you use them correctly, it will provide you the greatest probability trade setups for one, generating consistent profits, and it's also a great way to hedge risk. Now, options were created as a risk tool. That's why they were created, to hedge risk. For agricultural products, then the bonds, then now everything. So it really all comes down to math of probabilities, and that's why they're good. Now, here's your distribution curve of price. So when you look at an option platform, this will be a Google example, you're going to have all this information. You're going to have the implied move. In this example, it's plus or minus 4%. You're going to know days to expiration on that particular option series you're using, and you're going to know the at-the-money price. You're going to start with that. So all option pricing starts at the money. Now that's where all the supply demand will be, and that's where the first price is set, and that's at the top of that curve. Now then, once that's set, then you set the adder calls, strikes, adder puts, and this is what we call option skew. So in this example, they're looking at a theoretical plus or minus 4%. So 4% down, 4% up, and that's based on 10 days to expiration, and that's based on the price of $500. So that would be 480 to the downside, 520 to the upside. And this price movement between these 2 points over a 10-day theoretical period is what we call the expected move, and that's a 1 standard deviation move, or 68.2% probability. So you can see that if you start buying, say, options way out here, let's say right at this 2 standard deviations right there, let's say 580 calls, if you start buying those out there, then you've got less than a 5% chance that you're going to be at the money of 580 by expiration. So you can see that understanding these probability statistics give you an edge for your trading. And even if you don't trade options, these can provide you great target zones to trade against. So if you know the expected move of 520 or 480, you can know, hey, yeah, I got a chance to get up there or a chance to get down there. But if I'm looking for a bigger move up here, maybe I'm not too realistic about my targets. So it's a really great way to look at statistics and use those to your favor. Now, trading is a business of probabilities, and to be successful as a trader, you need to focus on controlling your risk. And one really good step is to know the winning probabilities of any trades you're taking. And a real simple and free tool that you can use to measure probabilities is what we call the option delta Greek. Now this is a great Greek because it will not only, first off, it'll tell you the value of the option based on the underlying move, but it also is very useful to helping you measure the probability of a price move of the underlying itself without having to do a lot of work. You can just take a quick look at it and get that information. I'll show you how that works. So here again is that distribution curve. Now, when you go to your option platform and you look at option delta, you'll see like a 68 or 70 or whatever it might be. So if you see a 68.70 delta, that equates to that strike price as having a 68 or 70% probability of being in the money at expiration. So it's a back of the envelope way to look at a strike price you're looking at and say, oh, okay, I've got a 68, 70% chance this is going to actually be in the money. Now, if you were to look at the option delta further out that has a plus or minus 16, that's equivalent to that outside 1 standard deviation move. So in here, you can see the 520, right around 16, 480, right around that 16. And that 16 delta then says that you only have about a 16% theoretical chance of that being in the money, this price. So that helps you to determine, your probabilities of a trade you're looking to get into. Now here's an example on your option platform of what that kind of pans out to be. So this is looking at a 1 standard deviation move using the Thinkorswim platform, and this is your option analyzer on that platform. So here's all the information you'll have. So here's the at the money price, 582.45. Right here, days to expiration, 22. Over here, your expected move, plus or minus $34 based on that price, based on that expiration, 22 days. Now, so in an analyzer tab, you can come down and set your slices, which means you can set different break-even points or all kinds of different movement points, and you can set standard deviation. So here I set it for 1 standard deviation up, 1 down, punched enter, and it gave me this theoretical expectation of a 1 standard deviation move up of 622.28, 642.80 to the downside. Now, instead of having to do this every time you're trying to figure out a trade, what I do is I just come over to the strikes, look down, like in this situation, look at the 620 strike here, go over to the delta area right there, calls or puts your delta, and look at it. It says 18.18. So that's very close to that 16. So roughly, that's telling me if I'm going out here and buying, the 620 strike at whatever it's costing, the first thing I'll think about in my head is that, oh, I've only got about an 18% chance it's going to get there. So do I want to do that strategy, or do I want to maybe sell it, or buy it? So that's a way you can determine real quick, and it's a free tool. Now, by using this probability analysis, this provides the trader you're a very useful tool to determine price targets to trade against, and it's also super helpful for setting up your hedges. So based on the math of probabilities, you can see that approximately 68.2% of options bought are going to expire worthless, and based on this, it's a good idea for traders or investors to also consider selling just as you would buying. And it's this added strategy for profits or hedging. It's going to really make a dramatic and positive difference in your trading performance if you use it correctly. So this is why the professional money always looks to take advantage of selling options for either profit generation or risk management. Now, step 5 then is selecting the right income option strategy for your goals. And the goal of every trader or investor, really, you should be looking to select trades that are based on what provides the most consistent positive returns, not always that big greatest return home run type trade. And one of the best ways to achieve this is by knowing which income strategies are out there and available, and then selecting the one that best suits your trading style and plan. So everybody here today, we'll all have different amounts of capital that we can trade, capital that we can put at risk. We all have different risk tolerance that we're willing to take, and we all have different times of day that we might be able to trade. So you have to take that into consideration on any strategy that you're looking to use. Now, the basic income strategies that you have will be the covered call, the calendar spreads, diagonal spreads, long iron condors, and credit spreads. So they're all, really good strategies, but some are better for certain situations than others. For example, covered calls you might be familiar with. You're long, let's say, at the underlying, and then you sell calls against it to bring in some income, some premium. But what happens when the market craters like it has been over the past couple of days, and you're along those stocks? Now they're underwater. It's pretty hard to sell a covered call against that. So that's the thing you need to understand: which strategies are there, and then which ones are the best and provide you the best opportunity. So for me, my favorite income option strategy is the credit spread, for 4 kind of basic reasons. One, they can work almost regardless of market direction, which is pretty awesome. They can almost always work even if you're wrong. That's really cool. And this is a really good one I like. The probability is over 68%, even without adding technical analysis. So just think about it. When you put on a trade, you've got going into that trade 68% chance of winning, and you don't even look at direction. What if you could, add direction to it? That's going to increase that probability. So it's also perfect for hedging. And there are 3 types of credit spreads. You've got the bear call credit spread, the bull put credit spread, and the long iron condor. Now, the bear call credit spread is best used if you think the market's going to go down. So it's a bear strategy, and all you're doing is selling one call with the lower strike and buying another one with a higher. Now, if you have a portfolio margin account and you know what you're doing, you don't really have to do the credit spread. But by doing, if you're selling naked, you have unlimited potential downside risk. But by doing it as a spread, then you're capped on that risk. So that's why credit spreads can be very, very good. Now here's an example of a bear call credit spread. So in this example, you can see this is on the SPX, S&P 500 cash. So it's trading down here about 1988. Now look at all that, I call it open prairie. Look at all that sky, black sky, I guess you could call it, up above. And in this particular case, if you think the market's sideways or going to maybe even trend down, or it could even go up some, you can put this trade on by selling that out of the money call here above it, buying the call right above it. So in this example, it was selling the 2045 call, buying the 2050. So the short call was 2045, that red line. Now by doing that, you bring in a credit of $100 in this example. The difference between the $500 wide spread minus the 100 credit you brought in is your capital at risk, or the margin that's put up. That's all you have to put up, is that $400 for your margin capital at risk. Now if this trades and stays below that red line at expiration, that $100 stays in your bank account, and that's a 25% return on your capital at risk. Now the second type of trade setup is the bull put credit spread, and this is best used when you think the market will probably go up. Now, so this is selling one put while simultaneously buying another put with a strike, lower strike in the same month. So it's a bullish strategy. Now here's an example of this. So this we're showing win, and you're bullish on win, and it's trading right here at 207. Now you think it's going to go up, so you could either buy the stock, you can buy calls, call spreads, whatever, and look, it pops up, nice push to the upside. So the other way to do it that's a little bit less risky, also very controlled, is to sell the bull put credit spread. So you can see here, when it hit this low, it's down to about 189, but when it's trading here, you sold that put short, bought the put under it, $5 wide spread, you collected $130 credit right there, straight to your bank account. The difference is your capital at risk. So if you do nothing to defend this trade at all, the worst case scenario is, if it goes through your strikes, is that you lose 370. But as long as it stays over that short strike here at expiration, you keep the 130, your capital at risk 370. That's a 35% return on your capital. So another really great way to make consistent returns. Now the third one is the long iron condor. This is kind of known as the non-directional low risk strategy, but all it is combining that bull put credit spread and a bear call credit spread together. And so you get the benefit of up or down, and these you can leg into it. So if the market's kind of moving to the upside, you can put on the bear call credit spread. So if you've got a market that's been in a channel and it's going up here to this top end, you can sell that bear call credit spread out of the money. When it gets back down here, you can sell the bull put, or you can do it all at the same time. So it just brings in almost kind of a double credit for you. Now this is the interesting thing. So you're going to see the very difference between two long strategies and the risk profile. So I'm going to compare the risk to reward on two long directional option strategies. The first strategy is your typical, hey, let's go long, let's go long the stock, or let's go long calls. Man, the market's going to go up. We're going to make a lot of money. Or strategy two, you're going to be, yeah, I'm very bullish, but I'm going to be a little bit more conservative about it. So hey, let's sell an out of the money bull put credit spread. So let's look at the risk on these two. So strategy one is, hey, let's just go long. So you're going to buy the at the money 207 calls here. They're trading at 1140. That's $1,140 per option contract. You have infinite potential profit on it. Your max at risk is your premium paid of $1,140, but that might be a lot of money to some of the traders, because $1,140, that's quite a bit. Now that's a great strategy if the market keeps rolling to the upside and make a lot of money. Strategy two is still a bullish strategy, but you're going to be selling the out of the money 187 put, buying the 182 below it. So that's your bull put credit spread. The spread when it was put on was trading below the 189, which was a low, and 9.5% below when where it was trading at the money at 207. So now let's take a look at these and see how they performed when the market didn't go the direction you wanted it to. So here is strategy one. So John had bought this 207 calls right here at the money, and he was excited. Market's going to move up. He was going to make a killing. It did go up at first, looking really good, but then what happened? Boom. We've seen that enough times where the market just waterfalls down. So on the 5th, or May the 8th, John is scared to open up his P&L. The market's at 196. He opens up his P&L, and he's down $583 on one option contract. That's smarts. So he comes back, and on May 21st, finally when it's come back. So it's trading at $205, right here on May 21st. So it's only $2 below where John put the trade on originally. He opens his P&L up. He's still down $518 per option contract. Not a whole lot better, so he's still pretty bummed out. Now, Susan was bullish too, but she wanted to do a little bit more conservative trade strategy for a bullish strategy. So when Win was trading at 207, she sold the bull put credit spread here, way below where it was trading. So, here she was able to collect 130. She, had a max risk of 370, and she was happy as long as it closed above her short strike. She'd make about a 35% return. Now, the market cratered to the downside on the 8th of May, and Susan comes in and opens up her P&L when the market's trading way down here, and she's only down $38.50. So she's, that's okay. I can handle that. She can handle $38.50. That's a lot better than John, who's down $583. And then, the 21st, the market pops back up to 205. Susan opens up her P&L, and she's only down, oh wow, she's down, she's up. She's up $78.50 right here, but John's still down $518. So, what would you prefer? I mean, in a down market, you never know when the markets are going to crush to the downside. So that's the difference between the risk profile of these two trades. And the most forgiving trading strategy ever, in my opinion, is the credit spread. Now, it has, all those reasons I showed you, but here's a current example. And this was a credit spread that was set up last week on the 4th. So, these are, kind of directional. I look at everything directional basically, but using momentum, the market had a nice trend to the upside. And if you're not exactly sure, it's really hard to when you're in an uptrending market to go short, right? Because a lot of times these movements will just continue. And if you're buying directional puts or something and you get it wrong and the market stalls and goes sideways, you lose your money because of that time decay. So when it got up here to the top of the range here, fortunately, the momentum was shifting down. So I thought that was a good probability that we're going to see either a sideways action or it could kind of, drift to the downside. So sold here out of the money the 2140, 45 bear call credit spread when the market was at that time 2103. So it was like 40 points above that point. Now today the market, is at 2030. So let's take a look at this credit spread. So when the trade was put on, it was put on for $100 credit. So this is the SPX, and it's basically 10 times the size of the SPY. So if you were to do, you would have to do like 10 SPY contracts to equal one SPX. So this is equivalent to 10 SPY contracts. So you got $100 credit. It's a $500 wide spread. So your max at risk is 400. So that's your capital you put up, your margin. And it was about one standard deviation out of the money. Now, if you have this close below the 2140 short strike, then that's a 25% return. And this was all over about a 15-day period. Now that was put on the 4th. Today, that particular spread's about maxed out 100% profit. If you were to get out, you'd probably have to pay the market makers a little to get out. So right today it's about 25% return. That's 9 days because we got the benefit of the market rolling over. So you do 10 contracts, that's $1,000, and your at risk is $4,000. That's what you put up as capital, or you do one contract. So that's the beauty of it. Now here's what it looks like on your analytics. when you look at it, on the profile of your analytics, here it was your credit received 100, and here it is today. So you do 10 contracts, $1 per contract or $100 per option contract. The market, was trading at 20.31. That's $1,000. So here's what it looks like. Here's the 21.40 strike short, 21.45 long. So you're hedged. Here's where the price is right now. So, these are ways to make consistent returns. It's not your home run trade, but you can mix and match. If you want to add other stuff more aggressive, you can. That's the beauty of trading. You can diversify your risk. Now, here's another way to use it. This is the in-the-money bull put credit spread. And the thing is, when you start going in the money, you're going to get a risk ratio reversal. So here, if we just back up a second, you are seeing that bear call credit spread. Your max profit was a 100 and you're risking 400. So that's a negative risk ratio, right? You're risking 400 to make 100. Now you're okay with this because to make that 100, you're selling it out of the money, so you're starting out with about a 68% probability that this will be a winning trade. So you're okay taking less, less of a return because there's less risk. But when you go in the money, you can basically reverse that to potentially make 400 on a risk of 100. So that's your positive risk ratio versus negative. So to point that out, and then here's a positive risk ratio in the money trade on Facebook. So this was back on the 16th. It was a directional play on Facebook, so it could have gone long calls, long the stock, but wanted to do it as a put spread because there was good premium. So it was, going long right here on the 16th and looking at Fibonacci and momentum. So picked out targets right here. The prior high, that high was 99, so probability was to go through there. So it was trading at 97. So instead of, doing a traditional long type trade, sold the in the money bull put credit spread. So sold the 98 put, bought the 97 put below it, so it was hedged, was able to collect 60 cents or $60 per contract. Now, this is a dollar wide spread minus your 60 credit, so your max at risk is $40. So that's positive risk. Risk 40 to make 60, not a bad deal. You do 5 contracts, potential profits 300, capital at risk 200 is your margin. That's a 1.5 to 1 risk to reward. So that's the in the money setup, and this is what it looks like on the analyzer tab. Now, when it got down to $10 credit on the 22nd, went ahead and took it off. So that became a $50 per contract profit or 125% return on very little capital put up. So you can see here, you only had to put up $40 to make 50. So you can take a small account and start creating some pretty decent returns and go from there. And so that's the beauty of it. So $60 credit, 40 at risk, and go from there. So the one thing with the SPX though, you'll have to work it because the bid offer spreads can be wide, but you need to, when you put on like an SPX type trade, you need to do it on an up day, okay? So they're a little tricky because they can be kind of a wide, but you work them, you'll get them. Now, the other way to use these options is for your hedging, and I call it the offense-defense trade. So if you're long a core position and you want to keep that core position, you can hedge around it by selling premium or selling credit spreads. So here's an example on Lulu. It was long a call debit spread, short a bear call credit spread against it to hedge it. So it was a directional trade set up, and it was set up for good reasons. There was what I call this volatility squeeze, market going sideways. Let me change pin colors. So it was set up because what I call this volatility squeeze, really tight price pattern. And in these kind of patterns, the market either breaks hard to the upside or downside. Momentum was showing upside, so I wanted to go long. So went long. This trade set up on the 17th, right about there. And so just did a long call debit spread. And it popped up nicely, but then, if you look back, everything started to roll over. We had, high volatility was spiking up, so decided needed to hedge it. So hedged it on the 20th and ended up getting out here on the 3rd of September. So rode the core position all the way down, but it was hedged and then got the pop up and got out. So let me show you how this worked. So here's just another chart to show you. This is shorter term time frame. Trend lines are breaking, momentum shifting down on lower time frames, and decided to hedge. Now here's the trade setup going through this kind of progression. So the original entry was on the 17th of August. Did the 65, 67.5 long call debit spread. So risking 120, not a whole lot, defined risk. But then things started falling apart. Wanted to hedge it rather than get rid of it. So went out to the same monthly time frame, did the 72.5, 75 bear call credit spread. It was at $38 credit. Now, you can do it at that, or if you want to be a little bit more aggressive on your hedge, do 2 times that amount of credit. So entry was 2 times that credit spread. So that developed into bringing in $76 credit. Now, what that did was the net downside risk was reduced from $120 by your 76-cent credit. So you reduced your net downside to 44. So if the market just kept going down, rather than losing 120, your max exposure was 44, but you still were buying yourself time to see if the market could turn around. Now Lulu did fall apart on the 24th, went down 13%, and that debit spread was then down $80 per contract. Now the next day, though, after that big sell-off, bought back the credit spread. It crashed to 18 cents. So the profit from the credit spread, originally received 76, covered it back at 18, $58 per contract, profit on that. So use that as your adjustment. So take that off that original debit spread of 120. You adjust it by the $58 made. So that gives you your new adjusted price of $62 per contract. Now on the 3rd, Lululemon came right back up. It was at 128. So you could have sold at 128 here. You would only made $8, but by doing this adjustment, you ended up making $66 per contract, or 106% return on your capital at risk on that trade. So, a way to hedge around core positions by selling premium, either selling outright naked or using credit spreads to hedge your risk there. So here's the original 65, 67.5 long call spread. Here's the bear call credit spread, 72.5, 75. So you can see it's kind of the condor. The original spread was put on at $1.20 and taken off at $1.28. You had the credit spread at 76 as your hedge. Cover that back in at $18, so it reduced your debit spread to 62, and you exited out at that when Lululemon on the 3rd was back up to 66.50 right here and brought in $60. So just another way to skin the cat and use these to your advantage. And this trading platform you're seeing here is Thinkorswim. They have a great option analysis, but TradeStation's good as well. So those are the two that I like both. I use both of those. Now, so today I just wanted to cover, different ways to look at the market to help you make consistent returns and also to help you hedge. So this brings together ideas that you can start using in your trading and understand these concepts that will really help you become more consistent in what you're doing. So a lot of you here don't know me, so just take a few minutes to read some of these client reviews that I've got, and then we'll get into all your questions and I'll tell you more about these credit spreads and what you can do. So I hope you had time to read through those, but it's always really rewarding, when you're teaching and you're getting results and helping your clients out. So if you're any teachers out there, you know exactly what I'm talking about. So just wanted to share that with everybody here. Now, the next thing I want to do is talk about some simple things you can start doing now to start learning how to generate a steadier stream of income and also using these type of trading strategies for hedging. So what I'm going to offer here to everybody today is a great course that I've put together. It's on demand. This was a 5-hour course, and it's 100% on credit spreads, 5-hour on-demand course, step-by-step, just on credit spreads. That's it. So with this course, you'll also get the 183-page PowerPoint trading manual and my 13 option strategy diagram. But I'm also, for the special event today, going to give the first 30 that sign up a 3-for-1 special. So first off, you're going to also get a live support Q&A follow-up to this course, so you can come in and learn or ask any questions regarding the course. So here's the link for it. Use this link and just copy and paste that into your browser, and you'll pop up $97. And the other things you're going to get, you won't see anything but the credit spread course, but the first 30 here today, you're also going to get my butterfly course, high reward, low risk option butterfly course. And the butterfly is just an amazing trading strategy as well. And this course, and it's perfect, I did this because next week is option expiration for monthly options. And the butterfly is one of the best, very low capital cost strategies for trading option expiration. So the course is kind of designed around that. So it's a 4-hour course, 119-page training manual. My courses are very detailed. So you're going to get 2 courses for one, the trading credit spreads, the butterfly course, and a follow-up support Q&A live. Everything just for $97 here today. Now, if you decide later on you miss out on the first 30, or you don't decide today to buy, you can buy it on my website. These 2 courses, the credit spread course $197, that's $197 on my site. But today you're going to get it all for $97, plus the follow-up Q&A and a money-back guarantee. So if it's something that is not for you, just send us an email to support@PowerCycle Trading, which you'll see, and we'll refund your money back to you of $97. So here's the link again. So PowerCycleTrading.com. It's not PowerCycle, it's right there. It's realtraderswebinar.com/PowerCycle. And that should pull up a link. Now, if you have a problem with your browser, yeah, there it is. Thank you for putting that up. If you have a problem with your browser, then just change browsers. But so this is everything you'll get. Now the course, let's go through what you'll receive in the course. So you're going to learn in this course is how to use these credit spreads to create a low risk, high probability trades. So they're very good trade setups for high probability setups. How to use credit spreads on stocks, ETFs, and the index options such as SPX, NDX, which are really great to use. And then when and how to use, these credit spreads for deep in the money type spreads where you get that positive risk ratio. So go through that. And then there, you can see that you can risk very little money and kind of consistently start growing your account. So you can take a, small account and start turning it into a large account by using these credit spreads. And they're a great thing to use to complement your other trading that you're doing because it diversifies your risk. And then the big part, which I couldn't cover here today, is how you defend these trades if they go against you. So I lay out 6 defensive strategies with great detail for various different market conditions. So that's all part of the course. And then when do you use the iron condor? It's not a trade I always use, but I show you when to use it and when not to use it in the course, and then how to construct it. And then position sizing. So if you're trading a lot of different, option contracts, maybe your long calls debit spreads, but you want to also position size to diversify, then add some credit spreads. So it's a great way to do that, and I'll show you in the course. And then again, how do you take that kind of 78% probability of winning trade that you go into, turn it to 90%? That's what's beautiful about the credit spread. And then a step-by-step guide for executing the spreads, some really good technical analysis techniques that you can use for execution. best market times for the spreads. When do you put these things on? You put them on 7 days out, 10, 15, 20, 30. I go through 3 different scenarios about the best timings to put those spreads on. And then when to set the trade up, end of the day. And so you don't have to start, watching your computer all day. So show you how to do it at the end of the day and a lot more. So a great course. And then also I'm throwing in the butterfly course. And you're going to get all that today for the price of one course of 97. In the butterfly course, you go through the Greeks, what affects the butterfly, theta decay, how that impacts the butterfly, volatility, pricing the option, its effect on the butterfly, and then what is the foundation of the butterfly? What is a butterfly? Go through what the foundation is, and then go into great detail on butterfly spreads for those monthly option expirations, how to use them, and then the spread defense using a butterfly, and then the broken wing butterfly, very cool way to reduce your cost, and the iron butterfly, great volatility collapse type strategy. But you can literally take a butterfly spread and get into them as little as $10 with the potential upside for 190. So it's a great complement to use, and especially for monthly option expiration and for earnings. So in this course, you'll get all that, and you can take advantage of this upcoming monthly option expiration next week. So wanted to throw that in. 0 at risk, so it's a win-win situation for everybody here today. If you'd like to get started in doing these type of trades, or just to check it out if you've never done it before, but you want to find out a little bit more about it, this is a way that you can do that for 97 bucks plus money back guarantee. So I've got 30 spots. I'll know here I've got about 10 left. I got the orders coming through, so I'll let you know. But it's all here today for you at $97. So let's get into some of your questions, and let me put the link up again. Make sure that that's working. Now, does everybody see that link? I'm not sure. Yeah, there it is again. Thank you. Thanks, Kevin. So there's your link. Just put that in. Just click on it, copy, paste it to your browser. And again, I'm tracking, have the orders that come through, the first 30, you'll get all those bonuses. Now, if I go over a few, that's okay. So if you want to make sure that you're in, just put up your email address, and I'll confirm that you're in based on your email address that I see. So that's what I wanted to kind of show everybody here today. So it's a really great way to add another layer to your trading if you're not using credit spreads. It's a way to take advantage of the other side of the market where you're not constantly buying and losing that premium. Stephen, you are in. Confirm that you are in. CTTA trader. Option calculator. Well, you can use the platform, whatever option platform you're using. We'll have all those free tools or those tools for you. So if you're not currently having a platform that has good option analytics, then I would highly recommend Thinkorswim, which is TD Ameritrade. It's a free platform. You can just open an account in 5 or 10 minutes, and you can then download their Thinkorswim platform. Ken, if you can send me an email, and I'll address that. Larry@PowerCycleTrading.com. Larry@PowerCycleTrading.com. Do I recommend any books on options or reading? Well, this course would be one way for you to start learning, because it's a very detailed course that comes with the recordings as well. So it's a 5-hour recorded course, plus the PowerPoints are very, very detailed. So it's a training manual basically with lots of just real examples, so you can go through. I'm a kind of a visual learner, and I like to look at various examples, and that's how I trade, and that's how I learn. So this will help you if you're looking for real detail, a lot of different examples that you can go through. So it's a great course from that standpoint as well. And once you have it, it's on demand. You can take it from anywhere you are. Do I buy on Monday, sell on or before Friday? Usually it can vary. It really depends on the setup itself. So, but typically I don't like to usually do a lot of trades on Monday. I like to fill the market out, and I might do something on a Thursday or Friday. It just really varies. But the best time really for a lot of these spreads are usually if you can get into them on a maybe a Tuesday if you're doing weekly options, because then that's the sweet spot. Then the time decay really starts deteriorating. But it just really varies with the trade itself. I look at everything but based on the trade setup, and then look at what's the best strategy that I want to do for that trade setup, because I might want to do just outright go long options, calls or puts or something, or do a debit spread. So I do a combination of things, but I always will look at the credit spreads. If the premium's good, if you have a good implied volatility where you get enough premium and it just sets up right with the risk reward. You don't need any books for this course. It's all very, very step by step, very, very very, very detailed course. And then the butterfly course. It's a lot of material, but if you're going to be successful, you just go at your own leisure and go through the material and start out with the paper trading, and then when you're ready, go for it. So, yeah, so CR, you are in, you qualify, you are in. Let's see here. Oh, thank you very much, Richard. Thank you very much. Yeah, Mir, you're in. Yeah, you're okay. So you're going to get, um, here's what all you're going to get today. You're going to get the trading credit spreads for income course. It's a 5-hour recorded course, 183-page PowerPoint training manual. Plus, I'm going to give you the butterfly course. It's a 4-hour course, 119-page training manual, and we're going to do a follow-up support Q&A live. That will also be recorded and added to your package. We'll probably do that in about 2 weeks. We'll send you an email on that. All of this just $97. Now, if you want if it's something that doesn't work for you, you just send me an email, support at PowerCycle Trading, and we'll just refund your $97. So it's a win-win. So you can try it out, kick the tires, see if you like it. Most people love it, and go from there. Okay, Ying Zhu, you're in, and William, you're in. I see that you're in. Yep, confirm that you're in. So that's it, CR. Yep, Jerry, you're in. William, you're in. Do I prefer in the money credit spreads? I usually do out of the money. That's what I like to look at, the out of the money kind of credit spreads. But I do like the in the money if you've got a really good, strong push, momentum. I'm a kind of momentum type trader. So I actually do love the in the money, trying to get at least a 1-to-1 risk to reward. And with these $1 wide spreads, I mean, you can risk 50 to make 50, or you saw in that example, you can risk 40 to make 60. So I do like those a lot in certain situations. Cancellation terms are ongoing, yeah. So I don't really have anything. I mean, you could come back a year later and want your money back. So, yeah, Rand, you're in. Yeah, I'm looking forward to trading with you as well. Appreciate that. Yeah, and then teach your family. So you'll have this as your library. You can use this, and the concepts are the same. They don't change, So once you have down the foundation of these trades, that's all there is. Is it better to leg into a condor? Um, it varies. I mean, if I usually will leg into them, probably to answer your question. Yeah, I tend to never really put them on as one spread. I tend to leg into them. Yeah, so you can hang on to it 30 days. You'll have access to it after that as long as you want. And if you don't, after 30 days, if you want your money back, you just send us an email, and say, just requesting your $97. You won't see the bonus courses on this payment, your payment receipt. So these are bonuses that I'm just giving extra today.